So what an ETF does is that it allows you to trade real time. Okay. So if you have a call to make on the market, instead of buying a normal open-ended mutual fund, you buy or sell the ETF on the market in the market.
A good ETF that has got good AUM, at least a few hundred crores, because this is picking up in India. There are nearly 2.6 crore retail investor folios in ETF. So retail is contributing to nearly 97% of the ETF volume in India, and 8 lakh crores worth of investments are happening through ETF. Why have active ETFs not really taken off in India while ETF volumes are soaring? Smart beta category of ETFs are the talk of the town. So with smart beta, what we want is when market is going up, we want to be invested in all the right stocks through the ETF.
Ask you a question: how does one enter and exit these ETFs?
Excellent question, Manoj, and that's where the rubber meets the road. My favorite phrase.
How would one track the risk associated with it? How will you manage risks with respect to ETFs?
Investing is all about reducing risk. Right? You don't want allocation. You don't want one particular ETF to have way too much allocation. Don't pick too many ETFs from the same factor. Then you don't have enough diversification. To monitor the correlation of the various economic and the market indicators that we're talking about. And the moment you see certain correlations weakening, you take adjustments. Hi, welcome to the M2M podcast. Today we're going to cover about ETFs, exchange traded funds. Why is there a lot of excitement in ETFs? How are ETFs different from mutual funds? What are the hidden traps of investing in ETFs? How do you know which ETF to invest in? What are some of the tips in ETF investing? Can ETF help you really make long-term wealth? Apparently, some ETFs have given a 35% CAGR over the last 5 years. Is that true? Let's unravel a lot of these things in this episode. With me, as always, we have a dear Manoj, and we'll go through the ETF landscape in India and come back with power pack lessons on how to really generate long term wealth in ETFs. Manoj, today let's rock and roll on ETFs.
Sure, Ram. Excited to talk about ETFs.
Oh, that makes a good acronym. Excited Talk. All right. So let's start with the first question. Uh, Help the viewers understand the difference between ETF and passive investing.
Sure, Ram. Let's go back a bit and first understand what exactly is an ETF. And one step further, we all know what a mutual fund is. It's a pooling of funds where a professional is managing. Now, typically, what happens in a mutual fund is you invest and you get to know the price at which you got your units, that is after 1 or 2 days, because when you are actually buying or selling a mutual fund unit, you do not know, because it will be calculated on NAV of the NAV at the end of the day on which your trading is happening, which means you are actually losing out on the movement of that particular asset on that particular day. Let's take an example. Let's assume that finance minister has announced the budget and we expect markets to go up, and you feel Nifty is the best asset to buy. So you buy the Nifty, and as expected, let's say the Nifty goes up by 3 percentage points. You will not get the benefit of that because your Nifty units will be bought at the end of the day value. So you're losing out. Similarly, let us say you're expecting a crash in the market. You might be predicting it right, but you will not get the benefit of it. Now, what an ETF does is that it allows you to trade real time. Okay. So if you have a call to make on the market, instead of buying a normal open-ended mutual fund, you buy or sell the ETF on the market in the market, which is real time. That is the biggest advantage of having an ETF. Now, understanding what an ETF is a passive fund, okay, wherein a fund manager is not using his or her ideas, but is simply mimicking an index. Okay, so whatever is the constituent of an index, the fund manager will buy the same constituents and in the same proportion. Of course, there will be a little bit of a tracking error, and one of the ways of evaluating an ETF is how small the tracking error is. But essentially, in a passive fund manager is not trying to beat the index. It is more or less trying to give the same returns which the index is giving. And it's a great way to start investing, particularly in an asset class like equity, where you are confused as to which is a good stock, etc. So for a beginner, a Nifty based ETF is probably a great idea, a great way to start.
Awesome. Absolutely, Manoj. Not just start, but there are nearly 2.6 crore retail investor folios in ETF. So retail is contributing to nearly 97% of the ETF volume in India, and 8 lakh crores worth of investments are happening through ETFs. And as you rightly said, it simplifies the whole investing. There's better control. It's exchange traded, and guess what? Even NRA investors, for them, there's a big tax benefit. We'll talk about it later. But the fact that it is innovative, there are a lot of ETF instruments for commodities like gold and silver, and obviously the broad market indices, and also smart beta indices. So yes, ETF is definitely something that every retail investor should have in their portfolio. And in fact, we recently launched a couple of strategies in our basket, which are composed purely of ETFs. So
That's
we'll
right.
we'll talk about our Coral sector and Coral Smart Beta after that. Um, so yeah, so having said that, ETFs are, well, mostly passive, and there are some active ETFs too. So why don't you just help us understand the difference between active and passive ETFs, and why have active ETFs not really taken off in India while ETF volumes are soaring?
ETFs by design were meant to be passive. Uh, but what a passive ETF does not deliver is beating the index. And that is where the active ETFs come in. So, in an active ETF, the fund manager essentially strives to beat the index, not just match the returns of the index. Uh, so obviously they are a little expensive, but they also deliver superior returns. And that is probably the reason world over active ETFs have become very, very popular among investors. Okay, so you get all the benefits of an ETF plus the benefit of active management by a fund manager. Now, the reason why it's not picking up in India probably is because of the regulation around it. Okay, today an active ETF fund manager has to disclose portfolio on a daily basis. Now, that is not what a fund manager would like to do. Apart from the operational headache, you don't want to reveal what you are doing, your picks, etc., on a daily basis. Where will be the competitive advantage? So, I guess Motilal Oswal launched it, but they soon converted it back into a passive
The
ETF.
most MOST fund, yeah,
Yeah.
ETF.
Okay, but you know, we do have lot of ETFs which are modeled around active ETFs like the Alpha 50, low volatility ETFs, etc. You can probably share your views on that.
Yes, Manoj, that is my favorite topic actually. The smart beta category of ETFs are the talk of the town. And as you said, there are many themes that they track. Um, the significant ones being momentum. And these, the smart beta, basically they follow rules. It is a system. So the fund manager is largely passive there. The rules run everything, something that we love. We are all quantitative guys. So the rules run, And why is it called smart beta? Why not smart alpha? The moment you say smart alpha, it is active, right? The fund manager is actively scouting for
Higher.
alpha
Yeah.
and higher returns, whereas smart beta is by definition not alpha. Then it is beta. It is then why is it smart beta? So the nomenclature is such that you want to, what does beta stand for? Beta essentially is like a spoiled child. Hindi mein beta bolte hain na, spoiled child. Okay. When the child behaves well, he's amazing. And when the child is mischievous, then he will make your life hell. So let's take that as a acronym for what beta is in the market. So with smart beta, what we want is when market is going up, we want to be invested in all the right stocks through the ETF. And when market is going down, we want to be defensive. We want to lock up the mischievous child and let him cool down. So the algorithms are basically figuring out where the market is going, and in bad situations they are playing defensive, and when market is going to rally, they're going to play aggressive. So that's the broad thing, and here the themes are essentially around, one is momentum, where you track relative strength and sentiment, etc. Basically you're capturing upward price trends, and we all know that markets in the long term tend to go up. So if you are figuring out how to stay invested in the good times, then you will make a lot of money. The second theme is quality, of course. So then again, you can measure quality through balance sheet strength and earnings growth, etc. Something we do in our roots and wings investment philosophy, and we've done it over many years and have seen fantastic results. Especially the emerging companies have given beautiful results. The third category of smart beta could be around volatility. So again, this is making sure that your drawdowns are less, your uh, the in bad times the market, your thing tends to fall less. The most popular and the highest performing is the fourth one called alpha. So here basically the index methodology will calculate the alpha on a rolling basis, like 6 month or 1 year alpha, and pick those stocks which are giving high alpha, and they may do this at the end of every 3 months.
Yeah.
So if the fund is ETF is rebalanced on a quarterly basis, and like we do, right? Normally this tends to happen on the February and uh,
May, August.
May, August, and November timeframe. There are few other strategies which also come under smart beta, but I won't give them too much of a bhav, because one is around dividend, and smart investors know that long term, you need capital appreciation. That's why you're in equities. The other is equal weight strategies, which is actually good. I'll correct myself a bit there. Equal weight strategies tend to do better than non-equal weighted. Like for example, Nifty 50 will have certain weights. Now, when a new stock is entering Nifty 50, it will probably have a lower weight. Whereas in an equal weight Nifty 50 index, this will have equal weightage. So the chances of a new entrant doing better are higher than somebody who's sitting there for a long time. So therefore, equal weight tends to do better over time. So equal weight is also a decent strategy, though you may not get the kind of kick-ass returns that Nifty pure alpha could give or a Nifty momentum could give. Then the other one is around market segment based, which is anyway broad market indices. So these are the broad uh, smart beta investing toolkits that we have in ETFs.
A beautiful explanation. But let me ask you a question. How does one enter and exit these ETFs?
Excellent question, Manoj, and that's where the rubber meets the road. My favorite phrase. So you start with obviously what is the profile of the investor? Is he an aggressive guy, moderate guy, or a conservative guy? And based on that profile, you first have to construct a basket which meets the risk return appetite of the, is he a high risk, high return guy, or is he a low risk kind of capital preservation kind of a guy? What kind of alpha potential is he seeking? What kind of volatility is he comfortable with? What kind of quality focus does he have? And is he more inclined into small caps? Is he better seeking stability in large caps? And then the other point which I mentioned around, is he Does he want equal weight? Like an aggressive guy might prefer an equal weight, whereas a conservative guy may want no change in the composition. So you start with that as the basic point, and then you have to obviously have a portfolio that meets these and figures out the right expected return, target volatility, portfolio beta, the likely maximum drawdown, and other factors. So for an aggressive guy, you will have a mix which is maybe geared more towards momentum and alpha, whereas a conservative guy would have a more preference towards things like dividend and low volatility. So those are the broad buckets.
Ram, so you mentioned quite a few themes, volatility, momentum. Now, what do you exactly look for in a particular theme? Say momentum. So, how do you track that?
Yeah, so let's do pick up on momentum. So momentum is basically how prices are are trending upwards, and here I'm only talking about the ETFs that are there. There's a broader discussion we can have, and maybe we should do one episode on our gem portfolio, which is a pure quality come momentum, incidentally,
Yeah,
both. Um,
it's doing very well.
yeah, it's doing well. So momentum basically one is moving averages, right? So moving average, and when you say moving average, you can calculate based on simple moving average, which is, let's say, 20 days may what has been the average price, and then how is that rolling. So as of today, last 20-day average, as of tomorrow, 20 days, which is 19 days backwards plus the next day, and so on. So you then track the moving average, and you track this in terms of short short window and the long window. So typically, when short moving average is going below the long moving average, the market is trending to lose momentum and going downwards. Whereas if the short is consistently ahead of the long uh, window, then it means the market is trending upwards. There are other terms like Bollinger Bands, etc., which track the same thing, where you compute the moving average, and then you have bands which look at the up to two standard deviations from that. So you can look at so the interesting thing is around crossing the crossovers. So the algorithms typically look at when are the crossovers happening, when are they not happening, what is the cooling period. You tend to have false signals. So the if we are tracking uh, I mean, that's just one parameter. The other very important parameter is the relative strength indicator, so which is usually measured uh, by considering the last 14 data points. So you could take the last 14 months and have a monthly RSI. You could have last 14 weeks and take weekly RSI. You can even do daily. So the relative strength indicator is also a good measure of how trending is the market upwards, because it compares the gain and loss on a periodic basis and computes that. And that's a fairly established thing. You can find a lot of these on TradingView. Indicators are there. Yahoo Finance has it. A lot of those things are there. Then you also look at VIX, which is a measure for volatility. So if then you also look at Nifty 50 performance itself. If that's continuing to do well, then it means momentum is good. You look at price volume breakouts. So that's very, very interesting. Basically, when prices are going up on increasing volumes, it means that the market is kind of roaring. Then you also tend to corroborate this. This is all price action, but you also tend to corroborate with earnings growth. So if companies are doing well, earnings are good, then market also tends to do well. So you put all of this, and then figure out whether the market is in high momentum, and you invest in high momentum, then you'll tend to get very, very good returns. Um, so the key thing here is, how do you protect from the drawdown, because momentum is a double-edged sword, and there are times when the market is going down. So momentum indices, especially for example in the last 10 years, many reasonably well-known momentum funds have given negative uh, low double-digit returns, like -10, -11, etc. So that is something that one has to be wary of. So you're better off playing defensive when momentum is off, but when momentum is up, you could make pretty high returns. So that is on momentum, Manoj.
Very well explained, Ram. How do you, what do you look for in the quality theme?
So quality has many aspects, and just sticking to only quality theme may not always be the right thing. For example, in 2022, quality significantly underperformed because the market was getting into momentum and small mid cap. Um, so 2022 was bad, but then again, 2018 to 19, 20, 21 tak, quality had a great run, and then quality recovered again in 2024, and so one has to be careful. That's why it's important to keep a track on what's going on. So, as far as quality is concerned, so one is obviously how uh, debt leveraged our companies. And we've seen that in the last, especially after COVID, there's been a significant deleveraging of the India corporate balance sheets. So that was a positive factor. Then you look at what is the return on equity trend, because end of the day, amongst all the things that we measure, if there were just one North Star metric for picking good companies, it would be
ROE.
consistently high ROE, because that demonstrates how well capital is being allocated, that demonstrates well how profits are getting generated and reinvested into the equity base, so that you get a higher return on equity consistently. um, then you look at interest rate movement, that also tends to tell you how. Then you look at cycle positioning, uh, how is the economic cycle unfolding and how are you investing in that. You look at earning stability. You look at again quality premium, how much people are ready to pay for a high quality company, and this is where there are some terms in the industry like uh, quality at any price or buy at any price. For a high quality company is not, BAP is not good, buy at any price is not good, is what people say. So those acronyms and comedy aside, one has to, yeah, it's a fair point. Do you want to pay through your nose for a high quality company at, let's say, 90p or 80p? That's something that we should, and we've seen how companies like, I don't want to wish any names, but these are certain aspects you look at quality, and basis that, primarily the interplay would be to pick a good ETF that has got good AUM, at least a few hundred crores, because this is picking up in India, and good trading volumes, good low tracking error, and which is meeting the parameters, and you're reviewing them on a quarterly basis and rebalancing the constituents of your ETF basket.
Not only did you answer my earlier question, but you kind of guessed what is coming next, and you probably answered my next question as well, which was essentially on how would one track the risk associated with it? How will you manage risks with respect to ETFs? Maybe you can uh, elaborate a little more on
Okay.
that aspect.
Yeah, so investing is all about reducing risk, right? So there are multiple aspects. Let me just come back and give maybe a bigger picture of that. So first is, you don't want allocation. You don't want one particular ETF to have way too much allocation, probably limited to 20-25%. That's what I would say. Second is, make sure that factor wise also you're not over concentrated. So don't pick too many ETFs from the same factor, then you don't have enough diversification. Obviously, it has to be related to your risk appetite and the profile thing that we talked about earlier. Then you monitor the correlation of the various economic and the market indicators that we're talking about. And the moment you see certain correlations weakening, you take adjustments. You also monitor your drawdown limits. That's very, very critical to reduce. So if let's say a market is trending downwards, right? You may want to just move a good portion of the portfolio to cash. Then you adjust for volatility, right? So if volatility is high, then move to a more defensive allocation. If volatility is low, then maybe go more towards momentum. So all of these are key elements, and then you uh, have a rebalancing trigger in place where you kind of do this on a ideally quarterly basis, and monitor what's going on, and then make sure that the portfolio is, it's like tending to a garden, right? Prune out the weeds and water the plants, and keep watching how it is going on.
So great, Ram. I think that was a wonderful explanation and a great wrap up.
Yeah, thanks, Manoj. I think we've kind of reversed roles in this episode. I have gotten a bit deeper into it. I mean, a lot of numbers and quantitative stuff involved here. So, in addition, we also have sectoral ETFs that we didn't go, but it's a fair, straightforward point. So, that is something that an investor can also look at, in my opinion. And I mean, on that note, let's wind this episode up. Uh, 8 lakh crores plus, and soon it will launch cross 10 lakh crores. So I think we're looking at ETFs as the way to go in India, and something that every savvy investor must have in their respective portfolios. On that note, signing off, Ram, and
Manoj.
see you in the next episode. Happy investing.